Hey everybody, Preston Brent here with our weekly roundup for the week ending July 13th, 2018. Joker's Wild. That's kind of how I title this past week. It's been a really interesting time here for 2018. As we kick off earnings here, the Dow is up a little over 2%, 2.3%. The S&P was up, the Nasdaq was up, making new all-time highs, in fact. And we saw the volatility come down about 8.9% to finish the week around 1218 for the VIX. But it was a very interesting week. Joker's wild. We've had Trump over there warning NATO. We've had Trump yelling at Merkel in Germany for the oil pipeline stuff. We've got data that continues to show that we're in a Goldilocks scenario here for the U.S. But we've still got trade tensions, although they've eased a bit with China and primarily with Europe, looking like they may want to do a deal with us in the auto side so that Trump can claim a small win there if they move forward with that. And I believe Trump is going to figure out a way to get these 200 billion trade tariffs back off the table as we go into the midterm elections. I just don't see him really tightening the screws with China at this point in time. They'll do some back alley or backroom deal and they'll make some of that stuff work out. But we've got a really interesting market, as I said. 2018 is certainly not like 2017. We've got rising interest rates, the threat of two more rate hikes for the year, according to the Fed dot plot, but the markets are only pricing in really about one more rate hike for this year. We've got a tremendously growing federal deficit. We've got this potential for a tariff battle between us and China. And a lot of that's kind of overshadowing some of the strong corporate earnings that we're seeing coming out of the gate. We had a little bit of a mixed bag with some of the banks that came out this past Friday. JP Morgan was really the winner, but we've had a mixed bag with JP Morgan, Wells Fargo, and Citi. Um, but I believe, and in fact, a lot of analysts believe that we're going to still finish up about 19 or 20% earnings per share growth for this year. Where the trouble comes in is with the yield curve continuing to go lower and with projections for 2019 and then into 2020, earnings per share growth pulling back to 7% roughly for 2019 and an estimated 5% for 2020. That's where some of the concern and agita starts to come in. I've seen analyst reports all over the board, some expecting the S&P to grow annually maybe 6% next year, and others saying it's going to be a flat year with a recession coming in 2019, 2020. So who's right, who's wrong? And at the end of the day, you just don't know. We play the price action here. We take a look at price and volume. We look at where the markets want to go, and no matter how logical or illogical that may sound, that's where we go. If we try and guess, then it's just that, it's a guess. Although looking at the markets right now, we're seeing what the markets have slowly started to shift a little bit from about 2010, maybe 2011, to about the summer of 2016. According to data FactSet, which is a big, or Data Trek, which is a big research firm, I'll look at all the sectors and how they correlated with the major indexes. The correlations were relatively high, about 0.82%, but we're seeing that correlation come down to about 0.59 now, averaged across all sectors. So what that means is money is rotating. 1 week or 1 month or 1 quarter, we got a strong sector, and then that sector weakens out, and then another sector comes in, and that one's a strong sector, and that one weakens out, and then another comes into play. So we're seeing fundamentals of individual sectors make a lot more sense now than they did when everybody was going up with the indexes after we had the big move lower in 2009. So that is just another thing that signifies to me that it's more of a stock picker's game right now, which also indicates we're towards the stage or the tail end of a long secular bull market. How long can it continue? Well, it can continue for another year or so, but I still believe that, and I'm sticking with my personal projection, that we're going to go into a bear market, recession, bear market, sometime in late 2019, 2020. What's going to put us there? I happen to believe it's going to be Europe, not China, and maybe a combination of higher interest rates, but we'll see. But that's kind of where I see this. We are watching the yield curve. It's down even lower with the short end of the duration. moving up dramatically faster than the back end, the 30-year. So we've got a number of things pointing to potential problems in the future. I do believe if we take the two T's, that would be the Trump tariffs, off the table, we're going to make new all-time highs in the S&P. We've already done it in technology. We're continuing. We've made 3 new all-time highs where we've made an all-time high and we pull back and then we've taken that all-time high out. We've done it 3 times in the Nasdaq. We've done it a couple of times in the Russell, and we've only hit 1 all-time high in January on the E-minis, and that's it. As you see the screen right here, I've got the E-mini S&P 500 futures on there. You can see from the high to low in when we made the low on February 6th, we pulled back 12.14% from the highs that we made back in January 29th of this year. Okay, we pulled back about 12.14%, and it only took us a little over, I guess, maybe about 6 or 7 days to get there. It was a really fast waterfall move down. And then we've been choppy ever since. You can see where we're now at a major crossroads in the market. Okay. And I've been pointing this out to our members. Right in this area here, as you can see, we're in this resistance zone, what we call, I call it my R1 zone right here. In order to get escape velocity to come up here and make new all-time highs, I said, we've got to have a suppression of the tariff issue, and we need to see strong corporate earnings. We got a little bit of the suppression of the tariff issue back in this area right here. Remember, this move here was when Trump started beating the bushes on more tariffs. We had the 34 billion actually come off the actually get executed, but then what really moved the markets a little bit lower earlier in the week was, hey, we've announced 200 billion more in potential tariffs. Let's identify the goods and let's have it take effect in the end of August. I don't think Trump is going to put those 200 billion and more tariffs at 10% import tax on China at the end of August, because then we're only a couple of months away from midterm elections, and I think he wants the Republicans to retain control of the House and clearly the Senate. So I don't think that's going to happen. So I think the odds of us getting escape velocity here and going up here are really better than 60%. Okay. Now, the fly in the ointment, right, is if those tariffs come to pass, we're going to come down and we're going to come back down to our S1 support zone down here around the 2720, and we'll quickly find ourselves, because markets always overcorrect both to the upside and to the downside. We'll see that momentum carry us down to the 2700 very easily. And then depending on how those tariffs work out, if they actually take place, and then there's more, and China reacts negatively, and then Trump announces some more potential tariffs, we're going to be back down in this larger S2 support zone down here around 2650. It can happen very quickly, guys. Okay. You can see from the highs up here, it didn't take us very long to come all the way back down here to 2550 in less than a couple of weeks. Okay. So that is the conundrum of the market right now. I've been telling our members, keep some cash on the sidelines, because if we do get down here, I do believe they'll work it out really quickly. The markets will spook the politicians, and then you'll see the markets bang right back up here. Already the Senate Republicans are looking at trying to put some bills on the table that limit and restrict what Trump can do for some of the tariffs. Okay. And that'll have a tendency to move it up. Should we get down in this area? I don't think it's going to happen. But again, what I think doesn't really matter. What actually matters is where price action goes. I think the odds and the risk right now favor a little bit more upside action here. I think the corporate earnings are going to come in good for Q2. And as long as those tariffs stay on the sidelines, we're going to come up and challenge that number there. That's what I've been telling our members, and that seems to be where price action really wants to go. Okay. I was telling our members last Sunday evening, after last week's weekly roundup, I said the odds favors. We were down in this area right here. I said the odds favors coming right up into this area into earnings. And that's exactly what we did. In fact, Sunday night, I was telling people to go long Dow futures. All right. And this is where we're sitting. So again, the question mark is where to from here. And I believe the odds continue to favor more upside movement. Again, the big caveat here is where are those tariffs going to go? And it's what I call the Joker. Joker's wild in this whole market, and it's, for those of you that play the old form of cards where the Joker could assume any hand that you wanted or any card, and Joker's wild. It's a wild card. So Trump is the wild card. The two T's, the Trump tweets. It's a wild card in this market right here. Okay, and that is unsurprising, or not surprisingly, because Trump, he got elected on the idea of just shaking things up. Well, that's what's caused all of this agita. If you look to the left side of the chart here for this year, a lot of agita in this process. So that's kind of where we're sitting right now. If we look at the Nasdaq, you will see Nasdaq made new all-time highs. Okay, as you can see, coming into Friday, we made this new all-time high here, right up to 74.1425. Okay. And that's where we're sitting here. You can see where the 50 EMA here, this red line, we've got an upward vector on both that and the 200 EMA. Still doing fairly strong. And when you've got an index making all-time highs, right? Not 2018 highs, but all-time highs. And then you've got the Russell right here, Russell futures near all-time highs. It pulled back just a little bit, but near all-time highs. That's a good thing. Now, the fly in the ointment here on these indexes is, and if we look at the Dow actually, which is a good thing, and this did what I said it would do last Sunday, it would regain the 2018 open price. And you can see here, we're now above where we opened in 2018, so the Dow's in the green for the year, just barely. You can see it also regained the 50 EMA, well north of the 200 EMA, and both moving averages, exponential moving averages, are now slightly pointing up. That's a bullish thing. So the next prior pivot we've got to take out is this one right here, which is very close to this prior pivot here. So, and I haven't put it on the screen yet, but I'll go in and put it on now. We've got this zone right there that we want to take out. And then we've got an actual pivot point up here at 25.08. But we actually moved up over 25,000. So that was the psychological headline number. We moved into the green for the year, and we took out the 25,000 area. So that'll bring some more rat brain traders into the market, right, and chase the Dow a little bit. But if you remember, we were going long down in this area here, which is where ideally you wanted to be putting on long positions, okay? You don't really want to chase stuff. So that's kind of where we're looking. But again, what is the canary in the coal mine for me? First, let's look at China. The tracking stock or ETF for China is ASHR, ASHR. Look at it. China has already entered officially a bear market. We were as early as just July, the day after July the 4th, just a few weeks ago. China was down 27.98%, the tracking stock for the Shanghai index, right? Down 27, let's call it 28%, underwater, okay? And we gapped up just a little bit, but folks, look at the 2018 open price. We're still underwater a pretty good bit, all right, for China. I mean, really a real good amount. So China is hurting. Why? Because they're suffering more because of the trade tariff issue. It's going to hurt them a lot more than it hurts the U.S. In many respects, Trump made a strategic, he did something very good. If you're going to pick a trade fight, you pick it where you've got the better economics in the situation. You're stronger to do it. And yeah, you could sit there and argue, yeah, we're taking on more debt. Our trade debt is going up dramatically. But for the near term, this would be the time to pick the fight. And you've totally crashed China. But the problem with China is it's not like a normal economy like the U.S. It's more of a a communist or type environment. It's not true capitalism. So, and you've got President Xi in there who can be president for life. And their constitution is whatever Xi says it is. So they've got time to outweight Trump. They don't want a trade war any more than Trump does. So I think behind the scenes, they'll work something out. But look at how far off it is. And if we look at the Vanguard All World Index, this looks at this. And again, we're still underwater, right? I mean, we hit from the high today, or from back in January, we pulled back about 13.28%. We're still underwater. uh, from the all world index. So the rest of the planet globally is not doing good. The US is doing great. The rest of the planet is not. And if we look at emerging markets, just EEM, that one is going to look just as ugly. Look at this, guys. We are down. Here's the 2018 open price. We're down almost into a bear market. We pull back up. We're not in a bear market now, but we're still well below the 2018 open price for the emerging markets, primarily driven by a strong dollar. All right. So we're trying to bounce. We're trying to make this bounce here. And so we are susceptible to moving up and then rolling back over again. So the question that I'm looking at is, will the emerging markets and the rest of that planet, for that matter, including Europe, will they pull the US down, or will the US pull everybody else back up? And I think a big part of it is going to be related to two things. One, the strength of the dollar, i.e., where the interest rates are going in the US, and two, the trade tariffs. If the trade tariffs come off the table, and they come out with some joint communique from both China and the US that we've worked out a deal, you will see the market scream higher very quick. In fact, you'll see the emerging markets, you'll see the Vanguard All World Index right here in particular move back up into above the 2018 open price, and then you'll see the E-mini right here, the S&P 500 E-mini futures. You will see it move up and take out all-time highs too, because the U.S. is going to continue to have very strong corporate earnings through this year. In fact, the growth is expected to be over 19% for the entire year. One of the strongest earnings we've had going back almost a decade. So that's kind of where we're sitting here. And if we look at the Dow Jones transports, okay, remember, it is suffering. It is still below the 2018 open price. It is still in the red. It is below the 50 EMA. So again, another potential canary in the coal mine for the rest of the markets. I'd ideally like to see the transports participating in this rally, and they are not participating like I would like to see. So we've got to pay a lot of attention to where the transports are going to go. Okay. And let's watch it closely, because this is one that could have a cause effect issue on the rest of the indexes along with the rest of the world, right? Now, if we look at volatility actually came in this week. We finished the week at 1218. So the VIX fell. The VIX closed last week at 13.37. This week it closed at 12.18. So it fell, another about 9% for the week. So the VIX continues to come in. And you can see here we're in the green zone, right? Zone 1 for volatility. Each of these zones reflects in what we do here in our user group, different option strategies and things that we want to look at as far as trades and market dynamics based on where the VIX is falling and what range that they're falling in. So these are just some of the things that we're watching here. I do believe the VIX is getting to a point where it's low enough where we can expect some jolts back to the upside. And the only thing that's really been jolting the VIX up recently has just been on again, off again, Joker's wild kind of tariffs from Trump, his tweets, and tariffs are on, they're off, they're on, they're off. We're putting more tariffs on, that kind of thing. And that's something that is unpredictable. You can't plot it on the chart, which is why you've got to be willing to take profits a lot quicker than normal in these markets, and you need to leave cash on the sidelines, because should we get ugly with these tariffs, I guarantee you're going to need cash on the sidelines, because there's going to be stocks that crater. They're going to be really good buys should we cap 5 to 10% more value off their current price. Okay, so that's just something that we're watching very closely. If we look at the bond market, the bond market is very resilient. Look at this move up here in the bonds, right? The bonds have fooled a lot of big heavy hitters that have been predicting higher interest rates, and they have not happened on the far end of the yield curve. This is the 30-year. Why have they not happened? Well, I've seen a lot of analysis of reasons for this and reasons for that. It's the human nature to try and describe what happens with prices every day, right? Well, the prices rose because of this, or the prices fell because of that. But basically, at a very high macro level, We've never had a situation where interest rates are still at zero in a lot of the big economic systems of the world, over in Europe primarily, or at flat. And when you've got zero interest rates, and look at the 30-year or the 10-year German Bund, which is like our 10-year Treasury, and they're at like what, 30 basis points, 0.3%. I mean, it's crazy. They're very low. So a lot of money is still coming into the US markets, keeping and suppressing our interest rates down while driving our bonds higher. They're holding, it's like a magnet holding our bonds up and preventing them from falling down and having interest rates explode higher. My belief is, and I'm working with our members to make sure that when Super Mario Draghi, the head of the ECB, starts to take his foot off the accelerator as far as stimulus goes, because remember, they're still doing stimulus along with Great Britain, along with Japan, in many respects China. They just hide the way they do it. All of these markets are still pumping a lot of money into their economy, and the US is not. So that's causing some of these anomalies here, which is one of them, keeping interest rates fairly low and the back end of the curve fairly high as far as what's driving our yield curve down lower and lower. So we've got some anomalies here, unintended consequences. I do believe when Super Mario takes his foot off the accelerator, meaning he's going to start to take stimulus out of the market and stop it altogether and start raising rates, you're going to see the bonds crash. And you're going to see interest rates just explode to the upside. Look at the 10-year interest rates. We had that initial explosion right here, and we went up to 3.13. I was projecting interest rates up to about 3.04, and we blew through it and went up to 3.11. But look at it now. We're back down here. Our 10-year interest rates are at 2.83, and I think they can come down even lower. In fact, we may see them go a little bit lower and settle in down here. So this is where logic goes out the window, right? This is where logic goes out the window with interest rates coming down, even though our feds are raising interest rates on the short term. So our 2-year and our 5-year are going up very quickly because they're most sensitive to the Fed rate hike. Yet the 10-year and the 30-year are less sensitive to the Fed rate hike and more sensitive to economic growth 12 months, 24 months out, and inflation. And what the 30-year is saying is we don't see a lot of strong economic growth in 2019 and 2020. In fact, we don't see a lot of inflation out there. So we don't think the Feds are going to be doing that. So there are some things the Feds can do to manipulate the yield curve. They're not doing it right now. So this is kind of where we're sitting. And I do believe that interest rates can still come in a little bit and the yield curve can still move lower. If we look at currencies, the dollar finished flat to slightly down on the day, right? I do not think the dollar is going to go much lower than where we're sitting here right now. Okay. I just don't see it. It's in a choppy range, but I think there's more upside for the dollar than downside. By the same token, if we look at the euro and look at just the euro currency, not the euro dollar, but just the euro, I think there's more downside in the euro rather than upside. Okay, we've got a 3, 4, 5 Elliott wave pattern setting up with an Elliott wave 5 projection of around 1.14. Okay, that was my forecast. Now I could have come up with this projection with Fibonacci extensions off the lows here, as well as GAN, using some GAN, but this is a little bit cleaner on my chart, and this is what really works out fairly well. Okay. So this is, and we're kind of stuck in this support zone right here, and you can see this volume over price. We got a lot of it right here, so we're almost right at a value area right now in the euro. But I think the odds favor a little bit more downside in the euro. Okay. The British pound moved up a little bit, but again, I think there's more downside in the British pound. All right, so that's a little bit about that. Now we've got. And let's look at gold. And this is just, guys, I keep telling you, every week you hear me say, I like gold more to the downside and the upside. Look at this here. I mean, we made new lows, 2018 lows this past Friday in gold, 1236. I believe we can go even lower than this. Let me just put it on if you look at it, I believe the next psychological barrier is this zone down here, which I'm looking at as the 1200 area. I think we may get a little bit of a bounce in gold near term. If I put it out on a weekly chart, just so that you can see it, you can see here that this just tells me that we can come down to this area down here. If we break this, we sit right on this pivot right here, this key pivot, which was made in December of 2017, almost a year ago, right? And this is what we're testing right now. So I'm going to watch this. If this breaks down, we're coming to this support area right here in gold. This is a weekly chart. You can see overhead, we got the 2016, 2017, and 2018 highs. Huge resistance up here. I've been a believer that gold in the next 2 years going into 2020 is going to take all of this out. But for the short term, I've been bearish gold. As you guys know from my sessions every week, I've been talking about I would rather be bearish than bullish. I'm still of that mindset. Granted, we can have any kind of bounce higher off this. To me, would be just a move to add some more shorts and have this thing play itself out. There is no bullish divergence in these here. There's a little bit of a bullish divergence right here from this low here made in early July to where we're sitting now. So that would suggest expect a little bit of a bounce back up, possibly even to the 1260 area. But I think it could peter out and you'll see more shorts come in and push it back down. Okay. Silver is the same way. To the downside, we broke these triangles to the downside. That was the technical pattern forecast break to the downside. We are coming down to test this 1563 area. Now, longer term, I'm bullish silver too into 2020. But near term, I think there's going to be better prices to be had. I've got my toe in the water here, but I've got it completely hedged with a 16 strike put out in December. Right, so that gives me the right to sell. This thing could go down to 2 or 1, and I'm going to be selling silver all day long at 16. So I've got a hard stop here on this already in there, and I like using puts as stops rather than the stock because you can gap below your stop, but you can't with puts. So I've just got long puts at the 16 strike. So I'm going to just add to my position as we come down here because, like I said, in 2 years, I think gold is going to be up over the 1350 area, and I think silver is going to be back up over the 17.5 to 18. But right now, downside action is what I'm looking at there. Now, we're also looking at some things in copper as well, but that's for our members this Sunday evening. Also, let's look at oil. We've had some of the most, let's say, the most extreme moves in oil I've seen in quite some time. Okay. And it really started off in January where we had a huge extreme move where we started here, we moved all the way up and we came all the way back down again. That was in a very short time frame. And if I were to block it off like that, that's about a month and a half move, but very extreme. And the move trending up was just as extreme as the move extending down. This was as bad, if not worse. We came down. We came up, we came down, we came all the way back up, and now we're back down about 50% of that move, right? Of this move right here, which is a normal pullback area. Oil has just, and you can see the extreme on the move up in the MACD, right? And that just favored a little bit of a pullback. And now we're sitting here. We end the weekend, go into the weekend with an announcement out of the Trump White House that said Trump is considering opening up the oil reserves, strategic reserves, to loosen the flow of oil. And that'll be enough to move oil down another $2 or $3 a barrel. But it could be just a Trump tweet, and he never has to do anything just to get the oil down. Who knows? I mean, who knows? And again, it's a Joker's wild market, right? So I see Trump as the face on the Joker's wild card as you're playing a game. But this is kind of where we're sitting. For me, I will not. In fact, I left the market going short the oil, going oil futures as we went into close, because we could probably come down and touch the 50 EMA, which is 69.38, maybe more. But look at this. This is a daily chart. And if I zoom in this is one of the biggest moves we've had in over a year or 4 years, 5 years. Look at that move. We went from right around 74.25 all the way down in one day to 69.97. So call it 74 to $4.70, 4 points, a little bit more than $4 a barrel in one day. Huge move. So now it's digesting the move down here at the bottom. We may even retrace about 40% of it, 50% of that move, which means another dollar or two up, and then a rollover and a retest again. All right. So oil, there's just a lot of chop in the market right now. The term structure of oil futures going out in time, there was a really huge backwardation in the market, and now the further out oil contracts, it's still in a backwardation, but they're starting to move up on the back end of the curve. And if we look at the difference between, and if we look at Brent, let's look at Brent first. Or let me get Brent. Brent oil futures did not, it had an extreme move too, but not like WTI. But let me show you the difference between Brent and WTI. This is look at this move here. We went from about $2.83, meaning Brent oil was $2.83 more expensive than WTI, all the way up here to about 11 and a half. And then I had our members selling this spread, which meant you wanted to go short Brent and go long WTI. And it's $1,000 a point. Now we got out probably sooner than I would have liked, but we just got, because it's $1,000 a point. And then look at this fall here. Had we stayed in it, it would have been about an $8,000 per contract move, but it was the right move at the right time. Now we're back down in this area down here, and we're going to chop around a little bit. I do believe this spread could widen again, but these are fun trades to take if you understand the oil market. Okay. So that's a little bit about where we're sitting right now. If you're not a member, I highly encourage you to come in. We've got wonderful discount offers for you on this. I'd take advantage of them. We got a lot of international members in our group. We got a lot of things going on. For our members, I will see you this Sunday evening for our weekly market watch coming up, and just take a look at some of the key things I see across the commodities and across the equities, and some of the things that we got to watch out for this coming week. Otherwise, everybody have a really good weekend. Members, I will see you this Sunday evening for our weekly market watch. Ciao, folks. Have a good one.